This morning we have Rashika joining us to talk about Philly Green Bank. Sorry about I'm glad it ended up working out. I'm really excited to have you join us. So why don't you go ahead and get started? Tell us a little bit about yourself.
That's great. I'm going to project up on my screen and start. Let me know if you can't see my presentation. I see a thumbs up. We're good to go. Okay, great. Before I dive into our presentation itself, I figured it'd be better to introduce who I am and our organization and what we do. So as Danielle mentioned, my name is Rashika Ghosh. I work at the Philadelphia Green Capital Corp, which is the Green Bank affiliate of the Philadelphia Energy Authority. I'm pretty sure you've met our executive director in the past, Mary Rose Martinez, when she came to talk about CPACE, over the course of her career at PEA. So a lot of the work that we do at PGCC now, as we're more colloquially known because Philadelphia Green Capital Corp is a mouthful. We are really expanding on a lot of the work that PEA has already done in the Philadelphia market on, really advancing the clean energy economy, as well as finding new ways of financing it. I think the challenge with a lot of the energy efficiency work and sustainability work that we really want to do to make Philadelphia broadly a little bit more resilient and a little bit more energy efficient can seem really expensive. And the whole concept of, I'm sure, value engineering is something that you often think about in your role. And we're really here to make sure that you don't have to think about it as much. And as well as, we're here to also figure out new ways of making it, easier for not just individuals, but also businesses and all the different parties and organizations that are involved in, developing the clean energy economy a little bit easier and making it a little bit more straightforward for them to work with us. So I'm going to run through a few slides. Feel free to stop me at any point if you have any questions. And I guess, Danielle, if there's any timing restrictions, I know we said about 20 minutes, but I can talk for a while and I'd love to not and leave time open for individuals to ask questions. So feel free to stop me whenever. So as I mentioned, we're the Green Bank affiliate of PEA. We really do only operate right now in the city of Philadelphia, and we'd like to eventually kind of expand that out a little bit further into greater Philadelphia within PA. The reason that we're only in Philly right now is because we launched 10 months ago now in September of 2021. And this is just kind of where we're starting, kind of piloting out some of our products, figuring out where it works best, and then continuing to expand as we grow. So the concept of a green bank, I realized I've kind of skimmed over that. So we are not like a traditional bank. We don't do the whole checking account, savings account concept. We find different gaps in local clean energy economies and find new and innovative ways to fund different clean energy, sustainability projects, and energy efficiency projects to really expand that clean energy economy within our community. So when I say community here, it's Philadelphia. So the Green Bank in Philadelphia is really meant to help more individuals go green. We find new ways of bringing money for climate-related projects into the city. I'm sure everyone is incredibly familiar with the Vine Street Expressway flooding, and a lot of houses along the Schuylkill and the Delaware getting a significant amount of damage, and that really ties back to the fact that infrastructure here it's older. There needs to be a lot of work that really needs to be done on both older buildings as well as we're looking at new development, figuring out new ways of making it more resilient going forward. And so these are we work with basically all different kinds of businesses. Right now, our focus on our commercial side that we're working on is a little bit more on the nonprofit and multifamily property side. We're hoping to continue expanding that out to working for small businesses as well as larger businesses around the city. And then from the residential side, we're also focusing a lot more on low-income solar. More to come on specific things that we're doing there after this. And so this is just kind of our broader goals that were really tied to a lot of the work that PEA is doing, as well as just broadly figuring out new ways of, as part of expanding the clean energy economy, creating new jobs, really promoting different kinds of economic development, not just, creating new homes, but broadly figuring out ways if someone is living in a safer home in a safer environment that is more resilient, they don't really have to think about that part of their needs. And they can focus on, getting better jobs potentially, or focusing on other aspects of their necessities and kind of leveling up on the next part of the Maslow pyramid of needs. If folks are familiar with that one. And I kind of walked through all of this stuff, so I'm going to skip through the slide. And I mentioned that we have commercial products as well as some residential things that we do. From the commercial product standpoint, I think these two might be the most interest to this audience. I previously mentioned CPACE, which is kind of a complement to some of these things, and I'll walk through kind of how these two relate to CPACE. So for the first part, as you're going into looking at energy efficiency products, you may or may not quite know what you want to do. Or you might be at the point where you know that exactly I want to hit, these efficiency standards. I want to build a LEED Platinum building, but I'm not quite sure how to finance some of that design and scoping work. That's where our pre-development loan can come in structurally handy for individuals who are looking for that. So we call it a lightly secured line of credit, but the reason we call it lightly secured is because if you're a new building, we want to make sure that your building is going up. If you're a rehab project, it's basically unsecured. And so the way that it works is you get 24 months line of credit. If you want to finance energy efficiency projects, this is the way to do financing some of that design and scoping work. And based on the population of this particular group, you would most likely be the beneficiaries of this kind of a loan. So you would be getting the money from this, not necessarily having to take it out yourself. And so some of the rate structure and things like that may or may not be as relevant, but typically the way that it works is you can take it out up to $2 million. There's different structures really based on affordability and on green attributes. So that's why there's specific ranges. We're working with a loan provider called Inclusive Prosperity Capital. They are a spin out of the Connecticut Green Bank, which is one of the oldest green banks in the country. And they spun out kind of as a separate nonprofit to be able to provide and expand out the great programs that they really were able to do in Connecticut. And I'll walk through a couple of examples of what worked well in Connecticut and bring them to kind of like the national market broadly. So we've been working with them as our capital provider, and they would be the direct underwriters of these two loans that I'm about to walk through. And so their goal and our goal is really to just get capital in the hands of projects that are really looking to be sustainable, as well as really targeting more affordable housing communities and targeting nonprofits and really just broader underserved populations. So a lot of the stuff that I'm about to talk through, they're very flexible on, and it's really, they want to fund projects. So as a matter of fact, a lot of this stuff can be expanded and changed in the definition as we go into on an individual project by project basis. And I'd love to talk to individuals more specifically about specific things on their projects, but right now we'll be talking very broadly. So as I mentioned, pre-development loan side of things, there's a lot of flexibility in how it can be used. Typically the scope is if you are trying to hit certain, green attributes, say you're trying to do like a passive house, mass timber building, you would reach a very low interest rate because you would get an interest rate buy down from hitting those green attributes. Say you're doing something like a 50% affordable housing property, you would get another interest rate buy down from hitting that affordability metric. So that's on the pre-development side when you're still trying to figure out what you want to do and doing the design, scoping, energy survey aspect of things. The next bit is the aspect that you might be a little bit more familiar with, which is like how to finance actual energy efficiency projects. I know CPACE is one of the big things that gets talked about, and right now I still have no idea what's happening in multifamily, but I know it works with a lot of other commercial spaces. Catalyst is really meant to like bridge that gap in the Philadelphia market of working for multifamily properties as well as with nonprofits. And it can be used essentially in the same way as CPACE without the security requirements. So there is nothing to really worry about on the security side of things. You don't have to go through like the property assessment and everything like that. But it is, again, slightly lightly secured if you're looking at a new project, as well as can be taken out for up to $2 million for different terms, really based on what kind of upgrade you're doing. Like the term that you'll get for doing solar panels is different than if you get something for boilers. And that's entirely just based on the amount of energy savings that you get from the project itself. So basically, there's a lot of flexibility, and these are just the two things that we're starting off with right now in the Philadelphia market. We are looking to expand more and more into other areas. And there's always, I'd love to have that conversation just to kind of understand what your needs are. And so, as I mentioned, like the Navigator is kind of the pre-development side of things, and Catalyst and CPACE overlap a bit. You can use Navigator and CPACE together if you're looking for pre-development for a project that qualifies also for CPACE after the fact. And so you just have to pay it off before you, take on term financing, et cetera, et cetera. And then, let's see, there we go. And I'm sure you're familiar with a lot of the benefits of doing broader energy efficiency work, but really it just comes down to if you're investing in energy efficiency, yes, the capital cost up front will be high. That is a hard pill to swallow, but we hope that our products can make it a little bit easier. Broadly, as green banks, as I mentioned, Connecticut Green Bank especially, and a few other green banks in the market, they have had a lot of success working with exactly the same products that we're offering here. And really, it's focusing on buildings that might not have otherwise been able to get financed. I'll walk through a couple of like specific examples. But really, you do end up coming out with a higher property value from going green, having more, robust upgrades and not really having to think about, frequent maintenance costs. You don't really have to think about the energy burden aspect of it. And if you're creating a building that has, more sustainable qualities, they tend to be a little bit on the shinier side of things, and people tend to want to live in those communities for longer periods of time too. So from a positive outcomes aspect, it really does improve the lives of a lot of residents going forward too. And so I won't walk through this slide, but I think this is a little bit more relevant in terms of who can really use these loans. I mentioned that it's mostly nonprofits and multifamily, but even within multifamily, it can be affordable. It can be market rate for public multifamily as well as public housing authorities, as well as senior living and assisted living facilities going forward too. I'll walk through a couple of examples, but before I dive into examples, does anyone have any questions at the moment? Okay, then I'll just keep walking through the examples and feel free to stop me at any time. Great, so this is an example of how pre-development loan was used previously, and I will give the caveat that this was the two case studies that I'm about to walk through. They were both done in Connecticut. They have different utilities needs and different utilities, saving structures there, but I think a lot of it is still applicable in the Philadelphia market. So this was for a mixed use multifamily property, and it's supposed to be mostly affordable rate apartments, I think 30 of them above, and then the trust that was actually financing this property, they were hoping to create their offices on the first level. So they had all the money that they needed to actually finance the actual building of everything, but they were thinking about incorporating different energy efficiency practices, because at this point there had been no Energy Star buildings, no LEED certified multifamily buildings in Connecticut. So they were just kind of exploring. So they took this Navigator fund out, like a $500,000 loan, to figure out what it would take to just reach, the bare minimum Energy Star rating. And so with the findings of the energy survey, they figured out that if they installed just I think an energy efficient boiler system and HVAC system in each of the apartments, that would be more than enough to reach that Energy Star rating. So once they got the results of this survey, they basically went back to their borrowers and be able to say, hey, we just need, X amount more money for from our existing funding. And they were actually able to build it out and figure out a way to essentially become the first Energy Star multifamily property in Connecticut. It's a huge landmark and something that has kind of set like a precedent in the state of Connecticut of figuring out, if they were able to just use a simple survey, do a couple of extra bits of contracting work, they were able to essentially reach this really big landmark, and more projects have kind of followed in their path. Some using similar, Navigator funding, but others just using other sources of funding as well. And I think now there's quite a few more even LEED Platinum and LEED Green buildings in the city as well that qualify for this multifamily certification. And then second, I'll walk through an example of how the Catalyst term loan can be applied. So this is for a project that was an affordable housing senior living facility. They took out about $2.6 million to finance just a lot of substitutes in an existing senior living facility to upgrade their boiler system. What had happened was that their utilities costs were so exorbitantly high. It was about, I think, 30% of their overall operations costs, mostly for water and for heating. And it had gotten to the point where the operations costs were so high that they couldn't even justify having an air ventilation system on in their property, which is really bad because this is a senior living facility and we really didn't want that. So that caused a lot of push from the building's management team to figure out what they would need to do in order to, turn on their ventilation system again. So they were able to get an investment from, in addition to what they got from Catalyst, they also engaged with the MacArthur Foundation and another local CDFI to get investment and upgrades that they needed to do to get a brand new heating system, brand new hot water system, as well as a much better HVAC system. And because this is Connecticut, they had different utilities incentives that they were also able to use to kind of like bring down the cost of the project. And they were able to save about, I think, over $200,000 in their utilities costs every year because of these changes. And the one kind of like additional tweak to this project is initially they were looking at doing CPACE, but they couldn't do CPACE because that would have been really difficult with their existing capital stack and just with the way that their revenue structure was done. And so while CPACE would have actually worked, because in Connecticut, CPACE works for multifamily and affordable housing, this is an example of a project where it could have worked, but Catalyst was just a better fit for their particular project. And on that note, I think this is probably my last slide, but this is just kind of a breakdown of some of the different things that I talked about. Mostly been talking about Navigator and Catalyst, which are a pre-development and term loan, but I've also included PEA's commercial solarized and CPACE programs. I'm happy to talk a little bit more about those in detail, but really a lot of that. Oh, there's an error on this slide. We're going to ignore this slide, and I'm going to go back to, I'll send an updated version of this slide beforehand, but basically the interest rates here are a little bit off. So ignore those, please. And basically the way that this works is just around showing, kind of just where our products are at and just how they compare to each other. PEA and PGCC work fairly closely together on all of these. So actually the leads for both of these programs are individuals I talk to on a regular basis, and we pitch each other stuff fairly often. So if you have questions about either of the other two on the PEA side of things, I'm also happy to talk about those. But otherwise, I think this is all I had at the moment. Any questions from anyone at this time?
Thanks, Rashika. I actually wanted to jump in and see if you could talk a little bit more about where, if we were interested in using Philly Green Bank, where we could, how much information do you need to begin a review process, and where, especially for the pre-development funding, where in our design process would it be good for us to start thinking about it? Because one of the restrictions of CPACE that you've mentioned is that there are, and it's probably a good thing that there are certain performance metrics they have to achieve in order to qualify for funding, but at the same time, it limits the options for those of us who want something that will maybe support like a mass timber building. So I don't know if you could talk a little bit more on that.
Yeah, I just missed the last sentence that you said. Just you mentioned that it could support some sort of a building, but I missed that.
I think it was funding for mass timber.
Mass timber, yes. Thank you. I missed that earlier. Yeah, so in terms of timing for this, it can be, okay. So pre-development, I will say the other caveat to our current pre-development loan, the reason that there's an error on that previous slide is because we're actually in the process of updating how our pre-development loan works. Before it used to be a lot smaller, it had a lot more restrictions on how you could use it. And yes, the rates were lower, but it only went up to 250,000. Now, because we're trying to go up to 2 million, we've been working with our capital provider to kind of update how it works and the ways that it can be used for. So in terms of like the process and the timeline, when you think you might want funding for something like this, I say come talk to us sooner rather than later, always. There's always like a back delay, I think, of you can like use costs, I think, up to a year beforehand and cover those costs with the pre-dev loan. But come talk to us sooner rather than later. We want to be part of the process, especially if you're looking for something like construction funding and construction like funding after the fact. If you're considering something like CPACE or any sort of other mortgage lender or anything like that, we want to be part of the process just to make sure that anything that you do from the pre-dev side of things doesn't have any conflict with any other loans that you want to take out after the fact. So if you're considering doing any sort of, green attributes in your property, there is a very good likelihood that you'll qualify for the different levels that we have. I can walk through what the different levels are, but again, those are can be subject to change and might vary if you're in something like an opportunity zone. If you're doing, something like mass timber, to my understanding, I don't think any of those have been done in Philadelphia at the moment, but that's something that is being looked into and seems really exciting. And I know I think in New York, they're actually working, IPC is actually in the process of figuring out what it would take to do a specific, interest rate buy down specifically for mass timber. So did that answer your question? I'm happy to dive into a little bit more details of that.
It does. It does. It's just like a kind of a personal question because there've been a number of projects that, there's a line item that's like a significant percentage of the budget because it's difficult for contractors to dive into a new market in Philadelphia. So thank you. I don't know if anyone else has questions.
I do. This was really awesome. Thank you so much for presenting to our group. What does the disbursement process look like? Is it a lump sum at the beginning, or are there checkpoints along the way? And what does that look like on the owner side?
Yeah. So I'm assuming you're talking about the pre-dev loan, right?
For the Navigator and the Catalyst loans.
Okay. So for Catalyst, it happens all at once. It happens in the beginning. You're able to pay off whatever you need to at the beginning. And then you're paying back your interest over time, like over the course of whatever the tenor of the loan is. Pre-development, since it's a line of credit, it varies on kind of really like when you submit receipts and when you want your reimbursement back from the line of credit. I don't know how familiar you're with kind of like the home equity line of credit, but it works exactly the same way. I think to my understanding, a little bit. So basically you end up submitting like receipts as over the course of a time. You have this $2 million like amount that you anticipate you'll need, but it can function as a little bit of like a fund. You put in your receipts, you pay it back, like you pay the interest on whatever receipts that you put in. So typically those can be, I think they want like about like 50 to 100,000 for each like disbursement of the loan, but they'll pay it off in each chunk, whatever you need. So if you have like, an initial chunk of work that's already been done, like in the last, 8 or 9 months, and you're like, I need to get this money back, submit those first. And then, as it kind of happens, you can continue to submit more over this 24-month process. And you can close out the loan early. There's no prepayment penalties, or it doesn't have to be a 24-month loan if you don't want it to be.
And are there certain, like, it comes in a set amount, you submit your receipts, but in order to get that next installment, are there certain things that the owner has to show have been completed?
Understanding, no. It sounds like it's just it can be high level as a, hey, this is a receipt that my engineer gave me, and this is something that they are asking for, and I need to pay them, in the next couple of weeks. So this is the amount of money I need. It can be as straightforward as that. But if you have any specific questions, more specific than that, and there's specific scenarios, I can also go back to our underwriters just to confirm that.
No, that's great. Thank you so much.
I have a question. If there's transgression on the term of like the 24-month loan, what happens?
You mean if there's any reason that the line of credit needs to be longer than that? I think that can be done on a case-by-case basis. We've never had that happen quite yet because most of these loans tend to be paid off a lot sooner than that. But if that needs to happen, I think it's just a matter of discussion with us and with Inclusive Prosperity, just to make sure that, if it's because your construction loan is on its way, but just taking its sweet time kind of a thing versus there's other, restrictions on it. I think it's a different, it can be discussed on a project-by-project basis. Brian, I think I see your hand up as well. You're coming across super crinkly to me. I don't know if anyone else can hear you clearly.
Yeah, Brian, I think your audio is not working well. Do you want to type it in the chat?
Can you hear me now?
Yeah, we can hear you now. Yeah.
Okay. All right. So my question is, do you have any validation of energy performance as part of your loan? I know with CPAYS, we talked about that is a component of it. So do you look at, are you involved in that at all, or you just put the onus on the owner to have guaranteed performance? And so I'll stop there and I'll ask my next question after that.
Yeah, that sounds good. So with regards to kind of energy performance, the way that we're structuring the new version of the pre-development loan is that there will be kind of like a measurement and evaluation, like an M&E period, typically like after the project is kind of up and functioning, just to see especially if you're getting an interest rate buy down because of specific green targets that you were planning to build. making sure that you actually hit those over like a certain amount of time after the fact. More to come on how that's going to be structured. I think it's one of those things that we're talking about as we want this, but the execution could be a little bit more challenging than that because it requires a certain amount of software and just monitoring of the building itself. From the Catalyst term loan side of things, similar to CPACE, you do need to come in with like some sort of an energy survey or some sort of an output of this is the anticipated energy savings we want from these upgrades that we want to do specifically for this project. And proving that out over a certain period of time, again, would be nice, but I don't think it's quite required in the same way. For CPACE though, how long of an M&E period is there? I'm not familiar with it, so.
Yeah, I'm frankly, I'm not sure either too. I'd have to ask one of the, I know one of the engineers that does the application, so he might be able to answer that. But I don't want to misspeak. But so let me, if I could go with my follow-up question, which is essentially, I work with a lot of clients that are enlightened about hiring building enclosure commissioning agents, to validate the airtightness of a building, through the installation, but also through a whole building pressure test. Are either of these loans eligible to bring somebody like that on to help with airtightness, to basically validate that the building is being designed as tight as possible? Because there's certain initiatives that, design elements that you can employ, like, if you wanted to do triple glazing, that would be another upgrade that you probably need to have funded. And you don't always get to eliminate systems to pay for that, like eliminating perimeter heating. So airtightness is really important. So again, are you aware of building enclosure commissioning agents and consultants being funded through some of these loan programs?
I will say this is the first time I've heard of this, so I'm really intrigued by the whole concept because it sounds really necessary. But if it falls into, so in my understanding, nothing in that realm has been done yet. But the way you're describing it, it does sound like something that would fall onto like the pre-development side of things, because it would help determine what steps you would take in like not even just design, but the actual building and execution process. So this is something that I think I'd be happy to talk about in more detail, because it sounds like a very specific example. But I think that based on my understanding, and if the property is for a nonprofit or a multifamily, this would work.
Yeah, the enclosure agents are actually a very interesting consultant, because ideally they would get involved early in the project to help critique details, but they're really their primary involvement is during construction. So yeah, I think I'd more put it on other people's radar if they're interested in validating that. I'm fortunate to work with clients that already get it, but in the past, I've also worked with clients that it's been a tough lift, and I could use something like this. So, thank you.
Thanks, Brian.
David, do you have a question? You have your hand raised.
Yeah, I may have missed it in the presentation, but I'm curious with these programs, what the maximum term could be. So for example, having worked with clients at evaluating photovoltaics and looking at third parties sort of owning and leasing that back, they typically look at these things for a 20-year term, because it's at the 10-year, 7 to 10 year mark that they really sort of break even. So if you were to look at a program like this to get low interest loan to help finance EV, I'm just curious, like what would be the maximum term allowed by these programs?
Yeah, so it sounds like if you're looking for some like PV solar stuff, the Catalyst would probably be the better fit there if you're looking to own your system. And it can go up to a 20-year loan for that, because it would be whatever the term of either traditional PPA with the utilities would be, or whatever term lease that you're looking for. And so if you're doing a 20-year loan for something like that, you would get it out to, I think, a 7% loan, which could be competitive, could not be competitive with maybe some other financing terms that you might get from like another lender, especially a bank that you might already have a relationship with. Does that help answer your question?
Yes, that does. Thank you.
Cheers, Kevin.
Hey, thanks. Shika, thank you for the great presentation. I just wanted to ask about the rates that you're showing here.
Yeah.
How are these being impacted by the Fed hiking the prime rate? Do you expect them to go up anytime soon?
Unfortunately, we do not have the most control over what these rates are. As you saw in my misspoken slide that I had, the rates were different for the Navigator term loan than they are right now. And that is partially tied to the fact that rates have changed since the Fed hike earlier this year and this week, last week. So at the moment, we don't have really control over it. We try to give clients that we're working with them as much of a heads up as we can. And we're very involved with IPC and their process as they're updating the terms of this loan. I will say we don't anticipate much of a hike again, just given where we are in the market for the next like few months. But at least with the Catalyst term loan, because this is a longer term loan, these rates haven't changed since we started, and they've been fairly consistent even in the Connecticut market over the last few years. And since there are like emulator that we try to emulate, I will say that. More to come, basically, is all I have to say, unfortunately.
Yeah, for sure. What's the correlation between the two, between these rates and the Fed prime rates? So if the Fed increases the rate by 50 basis points, does the same translate into your rates, or is there an additional percentage put on top?
I will say it'll vary significantly, and the rates that we use are again based on IPC's rates, and IPC's rates are based on kind of their impact investing funders. So the pool of capital comes from their impact funds, and a lot of those are mission aligned individuals, and so their risk appetite is slightly different from what is in the Fed versus what we take on from our clients. So all of these the rates that are here are exclusive of any origination fees that are included in there, just for context.
Right.
And even some of those they can be flexible on it. But it basically to say that it's not directly tied, and it does not directly correlate with Fed rates. It is just really mostly based on the risk appetite of the impact investors that IPC works with.
Excellent. Thank you so much.
I have one more follow-up question. Sorry.
Yeah, no, you're good.
I'm curious if you give more sort of broad-based consultation on what other resources clients would have available to them. Say, local grants, discounts, etc. I know it varies from state to state, city to city, but I'm just curious if there's a part of this when you sit down with the client to figure out what's the best fit for the financing piece. Mm-hmm. If you're also helping them say like, well, you should look for these grants, apply for this to help also subsidize and lower the sort of upfront capital expenditure.
Yeah, I mean, that's honestly something I'm trying to get like more smarter about. And I know I've been like, we have like our own internal list of just resources that are out there. It's just similar to kind of the funding that we do, but also additional like grants, like additional, new market tax credits that can be considered, or other types of funding that could be helpful for financing some of this work. We're still driving into it, especially on the utility side of things, to get a better understanding. But we do have some of that information internally, and we're always happy to talk to individuals about that on a project by project basis.
Thanks.
All right, great. Do we have any last minute questions before we move on to our subcommittee updates? Great. Well, thank you so much, Rashika. I hope that we can maybe follow up on some of the commissioning questions and other items afterwards. And I'd love to share a presentation to our firms if that's available, because I think all of our partners in charge and everything should be aware of this as well. And we'll share the YouTube video once that's live, so you can distribute that as you see fit. So it was really, really informative, obviously, and be impactful in our industry. So I'm very excited to see where this goes. So thank you for joining us.
And yes, I'll send out the slides to you, and feel free to share them with everyone. Thank you all.
Wonderful. All right, I'm going to